Hi, everyone. Today is December 8th, 2022. I am Ashley Wilkin, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Hi, Orest.
Hi, Ashley. Hello, everyone.
So as 2022 comes to a close and we look forward to next year, I thought today we could talk about our outlook on fixed income. We've come off one of the worst years for bonds in history, and likely a lot of our clients still have an allocation to bonds. So with how ugly they've been this year, why are we still in bonds?
Well, excellent question, Ashley. Bonds have had their worst year in probably 40 years, really. But that said, bonds are now attractive again in valuation for the first time in 15 years because they have a yield. Okay, and the yield will help cushion any kind of price decreases in the bonds themselves. On the short end, for instance, the Fed funds rate started out the year at 0.25%, and the Fed has been increasing interest rates. So now the Fed funds rate is at 4%. Okay, so it's gone up a huge amount. The 10-year Treasury has gone up from about 1.5% at the beginning of the year to 3.5% now. So those are tremendous moves. Now your bond portfolios are actually seeing income. They're seeing a decent yield. So that should help overall mitigating another down year. As a matter of fact, it could be a good year for bonds. Our target Fed funds rate is 5 to 5.5% by spring. So you can see that we've already gone through the majority of the Fed tightening. So from here on in, it'll probably be more of a question of after the Fed reaches their terminal rate, how long they're going to keep it there. They may keep it there for a while, but we think the worst has been seen as far as the increase in short-term interest rates.
So in summary, you think that the interest rates are going to peak in spring of 2023 and the Fed funds is going to be around 5 to 5.25%.
Yes, 5 to 5.25, maybe 5.5%, but certainly probably 5% or maybe a little bit more. But at 4% right now, we've coming up from a 0.25%. We've already gone through the majority of the move.
So what are we doing in client portfolios to anticipate the peak in interest rates? Are we holding off on buying fixed income? Are we buying fixed income? What's the outlook going forward?
Okay. Well, right now we have a two-tiered outlook with fixed income. We have a short-term portion of the portfolio, which is about half of the fixed income allocation, and that's in money market funds. And money market funds at the beginning of the year, much like the Fed funds rate, were very, very low. Now they've come up quite a bit. The taxable money markets are around 3.5%. So that has certainly helped portfolios overall because money markets don't fluctuate any in principal value. So they're a good ballast, a good cushion in a portfolio. And now we're seeing yield. We also have a portion allocated towards the longer maturities. And now we're seeing yields of 3.5 going up to 4%. And we'll probably be increasing allocations to the longer end from the shorter and the money markets as the year progresses, because we see longer term rates peaking out at some point during 2023. So that's our game plan going forward.
Finally, a good reason to have fixed income in the portfolio going forward. So we appreciate your insights as always and look forward to the next video.
Thank you, Ashley. Take care, everyone. Season's greetings.
Happy New Year.